Welcome back to Main Station. So, in this video I'll be looking at the S&P 500 and I will be evaluating whether or not this could actually be the end of this correction, of this bear run we had since early October, late year, or in 2018. And yeah, so as you might know, I've been bearish on the S&P and mostly the USA market in general since I think like past right here. I didn't make any videos back then. I only made or I started making videos in this right here, I think, or not actually, just in this bear run we had right here. But I've been looking, of course, at financial markets but way earlier. So and we had this huge bearish divergence, as you might know, which had me, of course, quite bearish. As you can see, this divergence right here, we broke to a higher high, but we didn't in any way on the RSI. So this had me, of course, bearish. And or also, as you might know, in my latest video on the S&P, or in a video I did where I mentioned the correlation between 2018 and 2008 in the S&P. You might also know that what patterns I looked at. So, but anyway, well, this is the S&P, and we have seen a run from the bottom of now around 14%. So this is quite interesting. As you could have, or as you might know, we now have reached over the 1.5 retracement mark. So we have now made our losses back over, the loss we had in this correction we made it back already for at least half, or more than half of the loss. And we did this in actually quite a short time. Yeah, in like 17 trading days. So this is interesting. This is 3 to 4 weeks, so basically a month. You can see, yeah, basically a month. We made our gains back, which we lost over 55 trading days. So, and this is around 3 months. So this is quite interesting. And of course, usually in bear markets and in bear runs, retracements happen only around to the 0.618 mark. So basically, 33% is the usual retracement. After and after that we usually see further downside in a bear market. So as you might know, I expected this to actually retrace around the 1.618 or at the 0.618, and if it comes back up, then we will see it bounce off of the 1.5. Well, we haven't seen either of these two happen. And I looked at this box. If we go to the hourly, then you might remember this. We had this channel right here, this short channel, but we just made higher lows on the hourly and broke out of this resistance zone, and are now well above it, actually. Well, there's still a lot of resistance incoming. We have this very choppy action. So, but anyway, there isn't really really specific points of resistance. You could maybe look at 268 around this level, but other than that, there is nothing really until like 281 and maybe like 286. So this is interesting, and well, this could be an indication that this is not just a relief rally, but more an actually reversal in trend. So this could be, and I might be wrong in my further outlook on the US market, and at that point the S&P. So well, anyway, what I also want to mention is that we are actually seeing a rising wedge, and this is the 4 hour, and if we go to the hourly, it gets a bit more clear. You can see it actually very nicely, and I would expect this to sell. But even then, even if it sells, then we will definitely see a higher low compared to this low right here, around 233. We will definitely see a higher low before before we go any lower. So even though we reached above the 0.5 retracement mark of the Fibonacci, we still could actually see further downside. But I don't know if that is now the most likely scenario. But I think what will most likely happen is that we will see this rising wedge break to the downside. If this happens this week, I don't know. It could very well, actually, and I think it will, because we are actually getting very tight. And if you look at this on the hourly, then you see around like the 22 or the 22nd to 23rd of January, it will get very tight. So I think it will most likely break in mid this week. And well, where will we go? I think we could reach back down to or we will find support at around 258. We had a resistance right here, and as you can see, it has been support right here. Also this trend line, which marks the bottom line of this bear flag on top, could be playing a significant role. So you also want to look at that, and basically this cluster of resistance right here will be important when we come back down. If we just break through it, then which can also happen, since this is actually a very big rising wedge. Since this could also happen, then we most likely will look at the lows of like 253, and as you can see, it will coincide with our low we had since February 18. So this will be most likely then our next point of support, but that will only happen if we reach below the 0.618 mark of the Fibonacci. After that, we will most likely see a bounce. So this could be playing out if we just draw some arrows. So if we reach below the 0.618, then we will most likely reach to these lows of 0.53. And then we will see most likely a bounce. If we reach even below this level, then we will see most likely it bounce off of 251. So I'll mark these with 3 arrows now, and so the first scenario would be to reach back here. The second would be right here, or actually our second would be the 261, a bounce from the 0.618. Our third scenario would be to reach to these lows of our low back then, and our fourth scenario would most likely be to come back down right here and find support on this resistance point we had back then. So these would be my four targets. what will be most likely? Well, I think not this one, and most likely not this line, because this is quite a big rising wedge. So we will most likely, I think, reach either to the or we could reach to the 0.618 and see if we see consolidation then, which I could think is likely. Then we will most likely go to the low we had back then and see a bounce from there. Most likely not go to new highs, but what could happen is that we see a bull flag be playing out, and then I would be bullish on the S&P. If we just drop like straight through, then of course we would be bearish, but this is not going to happen in my opinion. Of course, what is important to mention right here is that this rising wedge is quite parabolic, or at least significantly rising, and hasn't been playing out. If we just draw something right here like that, which is more drawn out and slower. So and why that is because if we had seen a rising wedge like this, which would have taken like more time, then firstly our width of the channel would be a bit broader, which would mean that as you might know, the width of the channel is usually the first target we would reach when we break our pattern. So the more wider a pattern, the bigger the outbreak usually. So this is important, and what is also important is that if we would have seen it more drawn out over a long period of time, it would have been more corrective. But that hasn't been the case, and as you can see, usually if we see like V-shaped recoveries like we had seen, or like we've seen right here, then this usually marks a bottom and trend reversal. So this is also important, that this rising wedge is actually more bullish in the midterm future than bearish. So I think this could be a potential bottom for at least a few months. What could also happen is that if we do not see a bull flag and a more or less strong move back up to around 266, then we could come back down, or that then we will see most likely an equilibrium be playing out, and then we would see higher lows and lower highs, and just see something like this happen, where price moves in a channel, or in a coiling pattern, which is getting tighter and tighter until we see a break. And if we see that, then I could see this move to the downside again and break these lows and reach new yearly lows on the S&P. So a lot of scenarios could happen at that point. Very interesting. I will be looking at this, of course, and I will try to keep you updated. I think we will break rather soon on the S&P, and yes, you can trade this, of course. Also, this pattern you can see right here is playing out on quite a lot of stocks. So if you are looking for bigger percentage gains, then you can play stocks which had a similar move, and you can make a bigger profit off of these. But I think until I find a stock which I would trade instead of the S&P, I will trade the S&P, of course, only paper trading, and I will also keep you guys updated if I enter a trade, and you can then decide yourself if you are going to do too. So yeah, if you want to enter a trade, I think this gap right here will be most likely filled with a bigger candle to the downside, and I would like to see this trend line on the bottom break, and after that I think enter below under this touch right here on the hourly. And if you go to the forward, then I think I can decide it a bit more clear. But I think if you are a bit more conservative and you can see this going down further, then you can enter around 255 if we see a big drop, and also what you could do if we see a drop and we consolidate around this area, which we consolidated right here. Then you can enter after this consolidation breaks to the downside, which I think most likely it will if we see consolidation on this level. So you can wait for a break, wait for consolidation, and then see this consolidation break for a confirmation for more downside, and then trade that after the breaking of the lows of this consolidation. Yeah. But anyway, yeah. If you're more a short-term trader, then you also can go to the 50-minute and basically enter after this breaks right here. Then we can see, or what else can happen is that we see an island right here, and then we would see a close or a start of the next trading day right here below this trend line, and below the highs and below the lows right here. And then you could enter a short trade. But as you can see right here, I think the short-term time frame isn't as useful because we have quite a lot of higher lows. So there isn't like really a specific point of low which you can enter after it breaks. So I don't like this too much, and I think it would be maybe smarter to wait for a break and then for consolidation and maybe enter a trade then. So I don't think we will go much higher. We could, of course, we always can, but I don't think it's likely. If we come back down, touch it, and then come back up, yes, then we could see it go higher. But I think our next point then would be the lows right here, which coincide with the 0.382 retracement mark. So basically 66% gains from the lows. So this can happen, and we will also then still be in this rising wedge. So I will evaluate my predictions then. And as I mentioned, I'll keep you updated. Yeah, I hope you are looking at this too. And if you are looking at anything else I would like to see, or I would like to know about it. And yeah, I'll see you guys back next time. Bye.